Mutual fund or ETF? What fund should I buy? This is the very first question you have to ask yourself after you take that first step and set up a brokerage account. You might have your eye on a certain company, but if you're not buying single stocks and you're not looking for something exotic, you have to make a choice between two different kinds of funds: mutual funds and exchange traded funds or ETFs. They do have some similarities, but in many ways they're also very different. I see a ton of people out in the financial world giving incomplete or inaccurate advice to new investors. Let's waste no time and cover all things related to mutual funds and ETFs. Hey folks, I'm Daniel. Let's go. There is nearly 4 times as much invested in mutual funds as there is invested in ETFs. So with that information, you might think that mutual funds are the obvious choice. But there's a bit of history that explains why that's the case. They've been around longer. Both mutual funds and ETFs are just pools of investments. A bunch of different stocks or bonds are thrown into the pool, packaged and sold as a single fund. The idea of pooling money together from a group of investors with a defined purpose is not new. After a financial crisis in Europe in the 1770s, a Dutch broker created what many consider to be the world's first mutual fund. In the US, mutual funds have been around since 1924. They didn't all survive, but incredibly, what many consider to be the first mutual fund ever created is still alive and kicking, nearly a century later. It's still cranking out 10% returns. And although mutual funds have been around for nearly a century in the US, they didn't really take off until the 1980s. In total, US-based mutual funds now hold over $22 trillion in assets. This tops the economies of every country in the world except the US. If you skip over China and add up the economies of Japan, Germany, India, the UK, France, Russia, and Canada, you'd have comparable numbers to the amount of assets in US-based mutual funds. It's just incredible in its size. It's estimated that about 100 million Americans own mutual funds, which is approximately 45% of American households. That's nearly 1 out of every 3 people. Building on this trend of pooling money to invest, the first ETF entered the scene in 1990 in Canada, before making its way into the US in 1993. ETFs really took off after the Great Recession, and now they have about $6.5 trillion in assets under management in the US. So when it comes to pooled assets, whether it's the older, bigger, more established mutual fund, or the newer, more fast-paced ETF, we're quickly approaching $30 trillion in assets. Clearly, the market has decided that pooling our money to invest is a solution to convenience and diversification in investing. Don't you love capitalism? So which is it? Should you buy mutual funds or ETFs? Well, to answer this, let's get their similarities out of the way. They can both have a collection of stocks, bonds, or money markets or other securities in them. This means they're both vehicles that allow investors to, with one convenient purchase, diversify their investments into hundreds of companies. The options are basically endless, with over 7,000 funds out there for both mutual funds or ETFs. You can do domestic or international. They're both really convenient to purchase. You can get both index mutual funds and index ETFs. These are passively managed funds, benchmarked to large indexes. So far, so good. Now let's do the differences. And you know what would help you understand the differences? By hitting the like button and subscribing to my channel so you can stay tuned for my future videos. I do 1 video a week where I do a deep dive and try to add value to you in your financial life. Before I get into their differences, I want to highlight some common mistakes that I often see. It's usually someone comparing index funds versus ETFs or index funds versus mutual funds, but this is a false comparison. If you're asking this question, I'm glad you're here because you're going to learn something right now. You can have an indexed ETF as well as an index mutual fund. You can also have an actively managed mutual fund as well as an actively managed ETF. Active management just means that there's a manager or a management team actively buying and selling holdings to try to create the ideal portfolio for that fund. They do this in exchange for a commission. Now, if that isn't your cup of tea, that means you're looking for an indexed ETF or an index mutual fund. An index fund is a fund benchmarked to an index such as the NASDAQ or the S&P 500. The difference is not index fund versus ETF or index fund versus mutual fund. It's index mutual fund versus indexed ETF, or an actively managed mutual fund versus an actively managed ETF. You might think that doesn't matter, but I think it's important that you only invest in things that you truly understand. understand. You can't know if you're making a mistake if you don't truly understand the differences here. I think this misunderstanding came about because most mutual funds were most commonly actively managed funds. ETFs actually started out almost entirely as passively managed funds that were benchmarking an index. Although the majority of ETF are indexed, they're not all indexed. Over time, these differences have become less significant, with pretty much any indexed ETF having a comparable mutual fund out there that's also indexed, and some ETFs are actively managed. Okay, so let's start out with how they are priced. The first difference is that mutual fund prices settle after the end of the trading session. When you buy a mutual fund, if it's while the market is open or before the market opens, you're seeing the price from yesterday. But when you make your purchase, you're purchasing the next 4 p.m. price today. When markets close at 4, that's when your price gets locked in. So when you see a net asset value or a NAV price, you're seeing the total value of all holdings in the portfolio, minus any liabilities and divided by the number of outstanding shares. Although you might think that is unpredictable, it actually adds stability because it eliminates the incentive to try to time things. Nobody is day trading mutual funds and trying to time the market. So the price you see isn't necessarily the exact price you're going to pay. You might be close, but you can't know exactly where the fund is going to end. As a result, you just dollar cost average. You buy it weekly or monthly. Don't stress daily fluctuations of the market and move on with your life. ETFs also calculate a NAV, but that's not necessarily what you're paying. ETFs are more like stocks where the NAV is calculated at 4 p.m., but the price you pay is when your order settles. Your order settles when the market is open. There's something called the premium and discount. This number represents how much more or how much less than the NAV an investor is paying. The higher the demand for the ETF is, the greater the premium that you might be paying to buy that stock. This is represented by the bid-ask spread. The bid is what someone is willing to pay. The ask is the price the seller is asking. It's not rocket science here. So here's where the second difference comes in with mutual funds and ETFs. With a mutual fund, if you're buying a no-load mutual fund, which just means there's no front-end or back-end commission, the transaction costs for investing in the fund are absorbed internally and spread throughout the fund to all shareholders and is included in the expense ratio. With an ETF, that transaction cost is not absorbed. It's not a part of the fund expense ratio. It's an explicit cost that's absorbed by you, the investor. The bid-ask spread is usually charged by the financial institution that is facilitating the transaction. So if we're dealing with a 5 or a 10 cent bid-ask spread, you're paying that and it's not a part of the expense ratio. If you're dollar cost averaging good stable funds, it's not a big deal to eat the extra few cents every month. It's just something to be aware of. If you're a day trader with ETFs, that bid-ask might be chewing you up right now. A third difference is the expense ratio itself. Actively managed mutual funds have the highest expense ratio, sometimes greatly exceeding 1%, which is 100 basis points. Actively managed ETFs don't tend to be very expensive. An index mutual fund is often comparable to an indexed ETF with expense ratios that can go between 1 and 5 basis points. 5 basis points means that on an investment of 10 grand, you're only paying $5. It's dirt cheap. A fourth difference to keep in mind is that mutual funds are purchased directly from the financial institution. This is different from an ETF, which is purchased through a stock exchange. This means it must be through a brokerage account. Here's an example. FTEC is an index fund. There's nothing special about it. It's just the first one that came up when I was doing a search. So right here where it says ARCX, that means that the ETF is being purchased through the Archipelago network. This is a massive network that works with the NYSE and the NASDAQ. For comparison, let's look at FSBGX, which is a large cap growth mutual fund. Notice how there's no exchange information with the listing. You don't go through the NYSE or the NASDAQ to buy this. Instead, you're buying it directly from Fidelity, or you're using Fidelity's network of partner companies. The fact that you're buying a mutual fund directly from the company instead of on the exchange can present a challenge with a new investor, because the fifth difference is that ETFs often have a much lower minimum investment than mutual funds. Even if your brokerage account is with a company that doesn't allow fractional purchases, you just need to be able to buy the market price of an ETF. If the price of that ETF is 50, then drop $50 into that ETF and you're in business with your first share. If your brokerage vendor allows fractional fractional trading. You can technically buy a fractional share of that ETF for maybe just a few bucks depending on their minimum. Compare this to a mutual fund from Vanguard where you're not buying it through an exchange from another investor who's looking to sell. Instead, you're buying it from someone like Vanguard who has a minimum investment on their mutual funds of $3,000. If you have a bit of cash, that $3,000 isn't going to be intimidating. But if you're a new investor who wants to diversify into a handful of mutual funds and you're starting with $100 a month, you're going to want to choose a vendor that has a good selection of mutual funds with no minimum, or you want to get started with ETFs and buy them a few shares at a time. Okay, and this sixth difference is directly related to the purchasing process and purchasing options. Mutual funds default to being a fractional purchase. This is because nobody knows what the NAV is going to be until 4 p.m. You don't usually say, I want 17 shares of XYZ mutual fund. Instead, like with Vanguard, your initial purchase needs to be $3,000. After that, you can just buy a flat dollar amount every week or month. Round dollar amounts are the norm here, and the fractions are calculated after the close of the market. This is not the case with ETFs. Fractional trades are not allowed with every vendor. I think it was just last year that Vanguard rolled out fractional purchases with ETFs. Many vendors require that you buy a whole share, or if they do allow you to buy a fractional share, it has to be during trading hours because there's a fluctuation with the market price. Although this might seem inconvenient at first, it does have its upsides. You have greater options with ETFs when it comes to pricing. The most basic method of purchasing an ETF is something called a market order. This is simple. You buy the ETF at or close to the price you saw when you submitted your order. One step up from that is the ability to do a limit order, a stop order, or a stop limit order. These allow you to set parameters around how much you're willing to pay to buy a share or how much you'll require to sell. I won't get into the weeds on how to set these up, but the point here is that with ETFs, you have nearly unlimited options to control how you execute your buying and selling of shares. Something to keep in mind is that there's an inconvenience factor to not being able to do fractional purchases. So for example, if you're investing in a traditional or Roth IRA, you're capped at the annual max of $6,500. This comes out to $270.83 twice a month, or $540.66 every month. There's no fund out there, ETF or mutual fund, that is exactly this price every month. It's just not how it works. This is fine with mutual funds because you just set the dollar amount, but if you can't do fractional transactions with an ETF, you often can't do automatic investments where you just set it and forget it. Instead, you have to buy shares when the market is open. Each month, you might have extra money sitting around in your settlement fund because you're short of the amount you need to buy an extra share, and you have to wait until the money hits again to buy more shares. I just find that annoying. I want every cent working for me from day one. Almost all workplace retirement accounts are mutual funds. Because mutual funds are stable, their prices don't fluctuate throughout the day. Their NAV is determined at the close of the market at 4 p.m. and they're friendly to fractional purchases. Accessibility to mutual funds greatly exceeds ETFs in the offerings of most companies. I think this is the big reason that 100 million Americans own mutual funds. The workplace retirement plan is the first place you'll start investing. Your job might have ETFs that you can buy in your plan, but that would be an extreme minority. This automatically gives mutual funds a boost in usage. This brings us to the eighth difference, which is regarding taxes. If you have an after-tax brokerage account that holds an actively managed mutual fund, just keep in mind that it might be frequently rebalanced, which can create a taxable event. Mutual funds and ETFs are not taxed any differently from capital gains versus ordinary income perspective. However, if you own an ETF that's an index fund, there's very little management to it and very little rebalancing. As a result, it's unlikely to have a ton of taxable events that occur. The last difference that I see is fairly minor, and it's that ETFs have extremely tight daily holding disclosure requirements, which provides maximum transparency. This is very different from a mutual fund, which only has to report quarterly or semi-annually on holdings. I don't see this being a deal breaker for your typical long-term investor, but I just thought I'd mention it. As far as what I'd recommend, I would say it just depends on your situation, who your accounts are through, and what your personal preferences are. In general, I would stay away from actively managed mutual funds as they've been proven to underperform the S&P 500 90% of the time. Let me know in the comments what you prefer and why. I'm always curious to get feedback. All right, folks, that about wraps it up. Thanks for stopping by. I hope you learned something today and that this video added value to you. Until next time.